Good afternoon, everyone. My name is Gary Vogel. I'm the CEO of EGLE Bulk Shipping. I very much appreciate you taking the time to give us an opportunity to present about EGLE Bulk and the dry cargo market in general. I'll pass through the safe harbor slide here, and I'll jump right in because we have a lot of slides to get to. I'm going to move fairly quickly so that we have an opportunity for Q&A at the end. With me today is Frank Costanzo, our CFO, and Frank will speak in a little while regarding the company financials. So I thought I'd start out with what differentiates EGLE Bulk. We are a fully integrated ship owner operator engaged in the transportation of dry bulk commodities, but we are exclusively focused on the mid-size segment within dry bulk. Collectively, it's usually called Handymax. We specifically own Supramax and Ultramax vessels between 50 and 65,000 deadweight. We own 48 ships, including 2 that we recently announced the acquisition of that haven't yet delivered, pro forma. And of those 48, 44 are equipped with exhaust gas cleaning systems or scrubbers, enabling us to comply with the IMO 2020 sulfur regulation, still burning the fuel that was used prior to that regulation and scrubbing the exhaust gas from the vessel. And there's a financial advantage to that because we're able to burn less refined product, which is a lower cost. We employ an active management approach to fleet trading and perform all our management services in-house, and I'll speak more about that. And finally, we have what we believe is an industry-leading corporate governance and a focus on ESG, and I'll touch upon that as well. We're headquartered in Stamford, Connecticut, with offices in Copenhagen and Singapore, giving us 24/7 coverage in the global markets. This slide speaks to the fact you'll see the dotted areas, the Supramax and Ultramax that EGLE is exclusively focused on. We believe it's the most versatile asset class. Starting all the way to the right are the largest ships, Cape-size vessels, 100,000 deadweight and greater. They primarily carry iron ore and coal, 2 of the 3 major bulks, as well as bauxite. Moving slightly lower towards our size vessel, Panamax and Kamsarmax vessels also carry grain. Well, our ships carry all of the major bulks plus all of the minor bulks, which is essentially everything other than iron ore, coal, and grain, giving us a much more diverse demand portfolio in terms of products, as well as a geographic demand spread. And I'll touch upon that a bit more later as well. This shows the listed peer group in terms of dry bulk companies. What you'll note here is we're not the largest listed company, but we are the largest within the mid-size Supramax, Ultramax segment. We're also the only company focused on exclusively one asset class within dry bulk. And I think that's important. I mentioned that we're an owner-operator of the vessels, and having all our ships within a tight deadweight band of each other gives us operational efficiencies. If we had a Cape-size vessel and a Supramax vessel both open in Singapore at the same time, there's no way you could ever put that cargo from one ship on the other or vice versa, whereas we're able to do that much more readily because all our ships are very close to each other in size. So we think there's a real value in that focus. The next slide speaks to the improving fleet makeup over the last 4+ years. I joined EGLE a little over 5 years ago, and Frank's been with us for 4 years now. It's actually my 33rd year in dry bulk. So upon joining EGLE, really my first focus was a transformation of the business model to the active owner-operator, but also we definitely had to focus on a fleet renewal. The average age of the fleet was 9 years old. It would be approaching average 15 years old now, but what you can see here is our average fleet age is actually lower at 8.6. That's because all the acquisitions. We've acquired 23 Ultramaxes over the last few years, averaging 3.7 years old. That's the dark blue, and then we've sold 19 of our smaller, older, and least efficient vessels. In fact, at this time, we only have 3 ships in the fleet that are greater than 13 years old. You can also see on the lower right that as we've moved into the Ultramax segment and bought more modern, more efficient ships, that our fuel consumption per deadweight per day has gone down as well. This slide is an important one, I think, because it really speaks to the value proposition of our active management strategy. This is something that I've been doing the majority of my career. Our chief commercial officer and I have worked together now for over 20 years. And the way to look at this is there's 2 ways really that ships are employed. The first is called time charter, and you see the lower strata there. And time charter effectively is a daily lease. I think the analogy I always use is think of a car rental, right? You agree to pick up a car and drop it off at a certain location, maybe back to the same location, maybe a different location, and you pay a daily rate. And while you rent that car, you tell it where to go, you drive it where you want, and you pay for fuel. It's the same on a time charter. So when you lease your ship out, you lose that asset for the period of time. That's one of the detriments, I think, or downsides of time charter out. The other one is sometimes you'll hear companies say, we fixed a ship, we leased a ship out for 1 year. Well, in all my time, that doesn't really work that way. 1 year actually in dry bulk is typically, the period is about 9 to about 12 months, and about means 15 days. So you're talking about a period of 8.5 to 12.5 months. Well, that's an option you're essentially giving the charterer, the person leasing the vessel. And of course, if the market's low, you'll get the ship back on the early part of 8.5 months. And if the market's high, that option will be used against you, and you won't see the ship back until the very end. So effectively, I think there's an inherent flaw in the time charter out model. We do time charter our ships out, but typically it's for a single voyage or a couple of voyages. We prefer to live above that in voyage chartering. And on voyage chartering, we get paid a per ton basis to carry cargo. And one of the benefits of that is we can show up with any of the 48 ships that we own as long as they fit the parameters of the contract to carry that cargo. And actually, we can show up with the over 3,700 mid-sized geared ships in the world as long as it fits the parameters. And as I mentioned, many of our peers, many of the owners in dry bulk, all they do is lease out their ships on time charter, so we're a natural customer of those ships. So all of a sudden, I have much more optionality. Moving up the strata, we do what we call vessel and cargo arbitrage. And what that means basically is we may have a ship coming open, as an example, in the Texas Gulf. We may book a backstop cargo a couple months out for that ship in the Mississippi River. But before ballasting that ship over, we may find a ship in the Mississippi River for that voyage, and we can charter it in. And we may take it in for a voyage, but we might take it in for a year. And as I just talked about, that year comes with an optional period. So we have the first 60 days maybe for that ship. We can sell a derivative in the FFA market, hedging away the market risk for the balance of that fixed period and riding that optional period, what we call creating asymmetric optionality. It's a multi-strategy approach. This is just very high level to try and get across the fact that we look at the opportunity to really create value over and above index returns, not dissimilar from active management within the financial world. I think it's also important to point out the fact that, we do this on a very risk-focused, risk-managed basis. I like to use the baseball analogy. We're here to hit singles and doubles, not take undue risk and hit home runs. So that's the business model. And this really is the output of that model over the last 5 years. It starts the quarter after I joined EGLE. The green line is the Baltic Supramax Index, the time charter average of the Baltic Supramax Index on a net basis, adjusted specifically for our fleet makeup. And then what you see there on the blue line is our actual net time charter equivalent. After all the things we do, it distills down to, as if we chartered out all our ships, less commission, that's what's left. What you'll see here is the first year that I joined EGLE, we were building out the business model, hiring people, opened an office in Europe, and establishing relationships. And we trailed that index. It was a rising index, and it's hard to beat a rising index because you have a fixed revenue stream on voyages, and every day the index goes up, of course, that outperformance drops. Notwithstanding that, what you'll see is the last 4 years after that first year, with the exception of the third quarter of 19, we've outperformed the Baltic Supramax Index in each and every quarter. You'll see volatility there. And so we think the best way to look at this is on a 12-month trailing basis. Well, our outperformance over the last 12 months through the third quarter of 2020 was $2,100 per day. I can't speak about the fourth quarter except what was made public already. And that was at the early part of November. We were 73% covered at that time at a net TCE of $11,275 per day, a significant outperformance. What I can tell you is that today, the Baltic Supramax Index in mid-January is over $12,000 per day, so significantly higher. And again, of course, past performance is no guarantee of future result, but what you can see there is that's the gross Baltic Supramax Index at over 12,000, which nets out to around 11.5, and then you can apply whatever platform premium and the revenue from our scrubbers that is in that number as an expectation of where we may be going forward. But the takeaway is that the underlying market is significantly stronger than where the green line was in early November when we last reported. Of course, net time charter equivalent drops down to EBITDA. This is a slightly busy slide, but it'll come into focus pretty quickly, I think. The light gray bars are effectively the theoretical adjusted EBITDA of the company had we performed at that Baltic Supramax index. Remember, that's the green line here. The green bar here is actually the EBITDA attributed to the outperformance, or in the few cases where we trailed the market, the yellow is the underperformance aspect. And the dark blue line is our adjusted EBITDA, which is the sum of the underlying market and that outperformance. And what you can see here is, over the last number of years, and particularly in the last year through COVID, when the market was very challenged, Q1 and especially in Q2, where EBITDA would have been significantly negative, that outperformance played a really important part of driving the overall company EBITDA. Our view is, and we are constructive on the market, and I'll speak about that, as the market recovers, that the gray bars will increase dramatically, and the green as a percentage of the overall EBITDA of the company will drop, although on an absolute basis, our goal is always to look to outperform the index on a risk-managed basis. This slide speaks to really the operational leverage inherent in EGLE's model, and I think it's really an important one. It's for illustrative purposes. So if we look at the second bar for the left, that's based on the BSI, the Baltic Supramax Index for 2020, which you'll see was $8,189 from January 1st to December 31st. So this is not a projection of our EBITDA for the year. This basically takes a high level and said, based on the assumptions at the bottom, which the main ones are, if our platform outperformed the market by $1,000 in that rate environment, and the fuel spread, which drives the revenue, the savings by having scrubbers on our ships, what would that mean from an EBITDA standpoint? And the answer would be $56 million. If you move to the right and look at the market, what it was, since BSI's inception in 2005, it's averaged just under $17,000 a day. In that environment, which is only, now we're about $5,000 away from that, less than that, $4,500 away from where the spot market is today, the EBITDA of this company would jump to over $190 million on an annualized basis. Again, this is for illustrative purposes, but I think it shows the inherent operational leverage in the company. And the main driver here is that rates are very open to significant movement and inelasticity in dry bulk demand. And the other aspect is that our costs on our own fleet are fixed. So every single dollar of incremental value, whether through a higher market outperformance or revenue derived from our scrubbers, goes right to the bottom line. I just want to take a minute and touch upon corporate governance and ESG. Mike Weber, of Weber Research and Advisory, used to be at Wells Fargo, has been doing a ESG governance scorecard for about 6 years now. And what you see here is EGLE is the #1 rated company in the scorecard out of 52 public companies. The factors are on the right: no related party transactions, management are not remunerated on sale and purchase fees and commissions and things like that. We have an independent board with the exception of myself and other things. So we think that's important, and having good governance is not only the right thing to do, it translates to shareholder value as well in many studies, including in Mike's report as well. 2020, we also issued our first ESG sustainability report. We intend to issue our second one during the second quarter of this year. And you're welcome, of course, to go to our website and see it. And it speaks about the initiatives that we're taking to improve our carbon footprint, not just by improving our fleet with more efficient modern eco ships, but other things we're doing like low friction hull coatings, retrofitting appendages on the vessels and things like that. I'm now going to turn and talk a little bit about the dry bulk industry. Early on, a while back, I talked about major bulks, iron ore, coal, and grain. What you'll see here is those make up about 60% of total dry bulk demand globally. But actually for EGLE, we get about 2/3 of our demand from minor bulks. And I think that's important. I talked about the diversity of commodities and also geographic spreads in terms of where cargoes are loaded and where they're discharged. So it basically means also we have less volatility normally than the larger sizes that are reliant on primarily two cargoes, coal and iron ore, which really serve two industries, that being power generation and steel production. The other thing to note is China is an absolute imperative, a very important customer in dry bulk overall, but less so in the minor bulks. China is responsible for about 42% of major bulk demand, but about 22% of minor bulk demand. So very, very important, but somewhat less so than the larger sizes, being reliant on China. Another busy slide. These are a number of the major trade routes of the commodities listed below. It's an invitation again to go to our website. If you go to our website and hover your mouse over those commodities, it'll show you just the major trade routes for those. And again, it speaks to the fact that we have arrows going in all directions. So it lends itself to our active management approach by creatively keeping our ships employed in the most advantageous way possible. Large ships, often Cape-sized vessels, will load in Brazil, discharge iron ore in China, and go empty back to Brazil. Our ships don't typically do that. Our ships typically in China might carry a cargo to the continent and then carry, say, fertilizer from the continent into Brazil, and then maybe a soybean cargo from Brazil back out to China. So they're loaded much more of the time than the larger vessels, and it lends itself to that active management approach. Again, having relationships, having cargoes, and finding the best possible equation for maximizing revenue. This is the Baltic Supramax Index going back 11 years now, really to the financial crisis. I think there's two important takeaways from this slide. First of all, the last 7.5 years have really, we found ourselves really floating around the break-evens. Frank will speak about our cash break-even, which is around 10.5. And what you'll see here is, we just haven't broken out. Unfortunately, dry bulk has faced a number of challenges. Firstly, huge oversupply coming out of the financial crisis took a long time to work through. And then over the last number of years, what I've referred to as a number of unrelated black swan type events, such as the Asian swine flu, the Vale Dam collapse. Clearly, trade wars and tariffs have not been helpful as well. And then COVID-19 and specific to us, a collapse of the fuel spreads based on a number of factors, including the lack of demand for mid-distillates led by jet fuel and of course underlying crude prices. So we think given, a takeaway here also is that given positive supply to fundamentals, there's a lot of upside for rate development. I mentioned earlier that, dry bulk demand is historically very inelastic, and so given positive supply demand fundamentals, we feel that there's a lot of upside for our market to move fairly quickly. This is the supply side for dry bulk historically. The light blue line is the net between new ships coming in, which is the light gray bar, and ships that are being recycled, scrapped. And what you'll see here is for 2021, overall dry bulk net fleet growth is projected to be at 1.7%, a little bit higher for Supramax, Ultramax. But looking forward, as important as this year is the overall order book. The order book back in 2008 was 80% of the on-the-water fleet. Today, it's at the lowest levels in over 25 years at an overall order book of just 6.1% and even less, 5.3% for Supramax Ultra. And there's a number of reasons for that. More expensive capital, lack of financing, number of banks have pulled out, uncertainty around future carbon emission regulations, and things like that. So we're optimistic and believe that absent of a very robust market, we don't think supply will increase in the near future. Demand side, if you see here the graph on the left, what it shows historically, and I believe that relationship hasn't changed, is that dry bulk demand is inextricably linked to global GDP growth, and has been. Another takeaway, what you'll see is that we've had dry bulk demand growth in 18 of the last 20 years. In fact, the only 2 years we had contraction in dry bulk demand was in 2009, the financial crisis, and it actually was as a result of a lack of trade finance. Letters of credit couldn't be opened, and you can see it rebounded quickly. And of course, last year, based on COVID. Expectation is for that to come back quite substantially. You can see overall dry bulk is projected to grow at 4% next year, with minor bulks leading the charge at 5.3%. And I'll remind you, we just talked about supply coming in around 2%. So demand outstripping supply, of course, is naturally positive for rate appreciation and a positive environment. And I think we're seeing that play out in the early part of 2021. With that, I'll turn it over to Frank to talk a little bit about company financials. Frank? I think maybe mute, Frank.
I'll try to unmute it. Thank you, Gary. So we'll start on the income statement here, and I won't spend a lot of time on it because Gary did give you a good overview of our profitability, but I will emphasize the point that we do track along with the market quite tightly, with the primary difference being our outperformance that Gary highlighted at over $2,100 over the last 12 months. And that outperformance, of course, is made up of our platform, our operating platform, and our scrubber premium. So flipping to the next slide. This is the balance sheet and liquidity snapshot of it. I'll start at the top left at cash. You can see cash at $85.3 million as of September 30th, or the end of Q3. I'm moving down to the bottom right. You'll see the cash number plus undrawn revolver to get us a total liquidity of $105 million. I'll note up top in the graphic that our liquidity has been pretty steady around $100 million for the better part of the last 4 years. We always view steady as a good thing in liquidity, so we're pleased with our cash and liquidity position as of Q3. Next slide, please. This is a snapshot of cash from ops over by quarter. The dark bar is the reported cash from ops number, and the lighter blue bar is the reported excluding working capital. So you'll see that there's a lot of volatility, especially in the first couple of quarters of this year, and that volatility over time does even out. And if you look to the far right, you'll see the Q3 year-to-date picture, and you'll see it's only $1 million difference at down 2 versus down 1. So, as I noted, it does even out over time. And you'll also note that Q3 was a very strong quarter for cash. Most of that volatility comes from timing on accounts receivable collections. Next slide, please. This is a cash walk, and the top is a Q3 picture, and the bottom is a year-to-date through Q3 picture of the cash balance from beginning period to end, with a walk through the major categories. I think it provides a really clear picture of how the business works and where the money comes from and goes to. If you look on the top, we'll focus on the quarterly one. You'll note that revenues and operating expenses, the net of those two, generally comes in very close to EBITDA, our EBITDA result. So that's a very good snapshot of our operating business. And then moving right, you'll notice a lot of the CapEx numbers there: dry docking, ballast water system, and scrubber installs. And then keep moving right, you have working capital, then vessel sales and purchase. So a +5 would imply money coming in the door from a vessel sale. And then to the right of that, the RCF repayment that we completed in Q3, and debt service of $12 million there, which brings us to total cash of $85 million at the end of the period. The graphic below it is the same information, but for the first 9 months of the year. Next slide, please. This is a cash break-even per vessel per day, and so I'll focus on the column to the left, third quarter year-to-date, and I'll start up at the top of vessel expenses, or OPEX. You'll see it at $48.13 there, and you'll note the exact number can move around a bit quarter to quarter. The pop, let's say in Q3, higher was largely around the repatriation of seafarers home. As you may know, it's been well documented in the press that it became very difficult to rotate people on and off of our ships, and everyone's ships. That we all have the same problem in the industry, but we were proud to say that we got all of our seafarers home, and that presently there are none that are past their contract limits. But that did cost a bit more than normal, and that was what you see in the Q3. That should even come out in the Q4 numbers onward. Dry docking is another line that can chop around a bit. Dry docking is largely around the statutory maintenance that each of our ships needs, and that's driven by a schedule. And the schedule is in this presentation, the appendix, if you'd like to review it. So that is purely driven by schedule, and it can move up and down a bit. G&A below that is generally steadier, and you can see it at 1476. That's things like salaries, office, and so on. And that takes you down to the total operating. Below that, you have debt service, interest expense, and debt principal repayment. Debt principal repayment does move up and down by every other quarter as our Norwegian bond, which is in the Shipco silo, pays amortization semi-annually. So you'll see that number every other quarter in the debt principal line, and that brings us down to a total break even of around 10,500 per ship per day. With that, I'll pass it back to Gary.
Okay, thanks, Frank. So I just I wrap up and kind of before we go to Q&A, just to refocus that we are exclusively focused on the Supramax, Ultramax segment that we believe is the most versatile. We have a business model, an owner-operator, active owner-operator model, which we not only think is an important add-on, but we have a track record of outperformance now over the last 4+ years. We have scale in our 48 ships, all within a tight band of 15,000 deadweight of each other, and we supplement that with our time charter in fleet. We have the largest fleet of scrubber-fitted vessels. I'll spend just a moment here before I continue on and talk a little bit about the scrubbers, because I mentioned their value, their investment is really paid back by the fuel spread between HSFO, the fuel that we're allowed to burn, versus very low sulfur oil that 90+% of our peers need to burn because they don't have exhaust gas cleaning systems. The spreads for that fuel were up around $300 in early 2020 as this regulation came into effect. Unfortunately, with COVID and a lack of mid-distillate demand, that spread collapsed down to around $50. As of today, it's back around $100 as Brent and as crude in general has strengthened again. And in fact, the forwards for the next 2 years are up over 110. And $100 fuel spread environment delivers incremental benefit to EGLE compared to a non-scrubber fitted fleet of about $22 million. So that I think is an important differentiator of EGLE compared to most of our peers. We believe we have a well-capitalized balance sheet, and I think Frank spoke to our approach on leverage and cash management. I also mentioned our board is completely independent with the exception of myself, obviously, as being part of management, and all of us in the senior management have been in our areas for quite a long time, and I believe we have a proven track record. So with that, I'd like to maybe turn it back to Poe and see if there are any questions, but thank you for your time.
Gary and Frank, thank you for a very complete and comprehensive presentation. My name is Poe Fratt, and I cover EGLE bulk shipping for Noble Capital Markets. And I'd just like to highlight, if you would like to ask a question, there's a bubble in your lower right-hand screen that you can click on and submit a question. In the meantime, Gary, I mean, there aren't many questions just because your presentation, both you and Frank did a great job in covering pretty much all the bases. The one thing that I'd like to talk about is, maybe customer behavior right now. And, thanks for participating on the transportation panel too. But Gary, on that panel, it came up that, customers seem to be taking a little bit longer term approach and thinking that potentially, the ample supply of vessels over the last couple of years might be changing a little bit. Can you just talk about that, and then how you're positioned to capture, that potential demand on a longer term basis?
Sure. Yeah, we spoke about it yesterday, and one of the publications wrote about it. I mean, we are a spot player in the market. As I mentioned, we're quite constructive. We think, with supply being the best it's been in over 25 years, and what we believe will be a rebound in demand, not to mention with kind of COVID reopening and and central banks and governments clearly indicating and showing their intent to fully support economic growth, that overweights towards infrastructure spend and dry bulk. So we're not looking for long-term cover. Our typical way to get coverage forward when we want it is through the derivative market, because as I mentioned on reletting ships, leasing ships out, we lose that asset for the period of time. It's rigid. You're giving away an optional period where we can be much more dynamic with hedging through derivatives and keeping the vessel as a tool in our toolbox. So we are seeing more inquiry. There's more inquiry in the market, but what I maybe didn't articulate well yesterday was on the panel was, we're not takers of that. We think it's indicative of more confidence and also of the view that I mentioned yesterday. I think people haven't been penalized for being short to the market. Effectively, when you have cargo and no ships, that's a short position, and people haven't been penalized because the market has really not developed in a positive way because of a number of those headwinds and factors I talked about. And I think people are seeing the same fundamentals we are, and therefore looking for more coverage, whether through chartering in ships on a long-term basis or COAs at what they believe will end up being advantageous freight levels. So there's definitely much more activity. And then a big part of the dry bulk market is the middle ground, the operators. We're an owner operator, but there's plenty of private companies that operate simply by chartering in vessels, and so you see them looking to take more tonnage because they don't have that constant supply. We have 48 owned ships. There's companies out there that don't have that and need to renew it, and of course are looking to do so at a cost basis that they think is going to be attractive as the markets develop going forward.
Maybe another way to ask it, Gary, would be that demand for longer term or those inquiries, has that translated into is it more, as you mentioned, the charters, or is it the end users where maybe we're going to start to see some pressure on cargo prices?
Yeah, I mean, generally it's more the operator. We talked about it yesterday too. Obviously with carrying all the minor bulks, it's a very diverse group of customers, miners, growers, traders, receivers, but the business has become much more short-term, over the last number of years compared to where it was, 15, 20 years ago, with many more, longer terms. So, people are not looking as much to lock in freight because they don't necessarily have the contracts on the underlying commodities in which to, which effectively, freight just becomes a part of the overall landed price. So I don't see us, becoming like, it is in the liner sectors. But the inquiry for period is more from the operators and middle players than the end users.
Great, thanks. And you've done a great job with your fleet renewal program. Any way you look at it, your fleet has become younger and more fuel efficient. Do you see opportunities still out there? I mean, you're running out of older tonnage almost to sell. So now are you seeing opportunities now still out there? What's the biggest challenge? Is it financing, or is it bid-ask spread? Or, if you could just give us a little flavor on sort of the tone of that market.
Sure. Well, we just acquired 3 scrubber-fitted Ultramaxes within the last month, and dry bulk is quite a liquid, market. Historically about more than 100 S&P transactions a year. So pretty significant and opportunities, and we don't see that changing. We're running out of old ships, but I always use the term, fleet renewal and growth in one breath, and we've been more successful at the renewal than growth over the last number of years, partly because of the challenging market. But as we now only have a few ships older than 13 years, I believe the acquisitions can translate more to growth than just renewal. And we definitely see opportunities, and there's plenty of modern, high-quality ships out there that we're able to acquire. Our view is, people ask, why didn't you buy 6, 7 ships and sale lease back and lever it up? Our view to leverage is the leverage in this company should be, driven predominantly by the operational leverage, and being prudent about debt is important. We went into pre-COVID constructive on the market given IMO 2020. But of course, we didn't expect COVID, but we went in there with undrawn revolvers, and we were able to effectively draw as a precautionary measure and come through without any expensive, capital raises, things like that. So we think that's the right approach, but we definitely believe there'll be opportunities to continue to grow the fleet as we go forward. But our scale of 48 vessels is significant, and I think our track record shows that it's large enough to add meaningful value through our business model.
Absolutely, thank you. And Gary, one of the trends over the next decade, or call it 2 decades, is going to be focusing on lowering carbon emissions even more. You can slow steam all you want, and that's going to reduce carbon emissions, but it's never going to eliminate carbon emissions. Are you looking at alternative fuels? Are you looking at engine technology? And how much can you modify your existing fleet to potentially get to, net zero?
Well, net zero is going to take, completely new technology in the form of zero emission, fuels and propulsion systems that can, whether it's hydrogen, ammonia. And of course, a big part of that for shipping is going to be the fuel supply chain. Generating ammonia, on a green basis is going to take huge amounts of green electricity to do so. And then storage and not just storage prior to delivering it to the vessel, but on board. So I think it's a real question mark. We're members of the Getting to Zero Coalition. We want to be part of the discussion, a collaborative effort of the industry, and how to also fund not just the research, but ultimately that fuel supply chain, and of course what will be a significant competitiveness gap as these ships are first built, given the cost of that new technology and what the fuel will cost. So one of the things about our size vessels is because of all the cargoes that we carry, we go to hundreds of different ports every year. So, the logical progression, and we've already seen it starting on technology, is that you'll see ships that, for instance, LNG is a good indicator. You'll see that ships that keep returning to the same ports over and over are the first movers, right? Because they're able to fuel at the same places where you have huge amounts of capital expenditure for supplying at this point LNG and in the future other zero emission fuels. And so that starts with vessels such as cruise vessels, liner vessels that keep ferries that go back to the same place over and over, and then it'll trickle down to the smaller sizes and the tram fleet that's more diverse. So we will have some visibility into that because we simply can't be the first movers given the way our ships are traded. But we definitely want to be on the leading edge within our group to make sure that we're able to be first movers, because while this is a huge issue to solve, it's one that will get solved, and we think there's going to be major opportunities, commercial opportunities and competitive advantages to be taken for those that are willing to and to be at the table.
Okay. Any last word, either Frank or Gary, that we haven't covered? I mean, you always do, as I mentioned before, such a great job in covering pretty much every base. Anything that you'd like to leave us with as far as the last word?
The only thing I'd say, I mentioned I've been doing this for a very long time, and I really feel like we're set up in a really positive way. I full disclosure, I felt that way going into 2020 prior to COVID, but we've come through that. The supply side is only looking better. Fuel spreads are widening, which is particularly good for us. And I'm a sailor. I like to use the analogy. We're just looking for some flat water and blue skies, and if we can get that, I do think that the fundamentals are really supportive and constructive of the market. But I want to thank you for the opportunity for Frank and I to present today, and anyone who would like to follow up, we'd be happy to connect further today. So thank you.
Yeah, we'll definitely be following up, and I want to thank you for a really comprehensive and great presentation. I look forward to seeing how the 2021 develops, hopefully without black swans that we've seen over the last couple of years. But thank you for participating in NobleCon 17. And Frank and Gary, thank you so much and have a great day.